When investing in the stock market, you have to set your investment goals, deciding whether you want to invest or be a trader, and taking stock of your current financial health. Setting up an investing plan. The first step when beginning your self-directed investment program is to set aside some money to use for your initial stock purchases and to sign up with the brokerage of your choice. Keep in mind that you should not try to invest every bit of cash you have at once. Once you have gotten set up so that you can begin buying and selling stocks, you need to set up an investing plan. The first thing that does along with this is choosing a way that you plan on investing. There are many different ways that you can trade and invest, and they aren't necessarily exclusive. These can include a straightforward long-term investment plan that does not include dividend stocks. Some readers will prefer to invest strictly in dividend stocks because they have a goal of earning income from their investments. Others are interested in trading. So, what should your investment plan include? Start by determining the end goal. Is your goal to have $1 million at retirement or to be able to retire by age 55? Or maybe you are already 55 and have no retirement savings, and so you will have a different goal: aggressive investing in growth stocks to build up your assets to catch up rapidly. Regardless of what your goal is, you should clearly state the intention and have it clearly in your mind at all times. You need to know the end state of your investment program to take steps to reach it. For example, if you are 45 and want to have $1 million portfolio by age 70, then you need to figure out exactly how much you need to invest to reach the goal in the time allotted and then go from there. As a part of developing a financial plan, you should start a journal where you can keep your goals and other information recorded. That way, you can refer back to your goals and plans and update them as necessary, as well as evaluate your performance as time goes on. Keeping a written journal that you actively use in your pursuit of your goals is also a way that you can hold yourself accountable. Keep in mind that you don't have to set permanent goals. You can change your goals as circumstances dictate, but recommended that you only do this once a year. You need to stick to the strict pursuit of your goal for at least 12 months to fairly and accurately evaluate your progress. Once you have an end goal in mind, you also have to determine how often you are going to invest. At a minimum, you should be buying shares of stock at least once per month. If you can do it twice a month or even once a week, that is even better, but not everyone is going to have the ability to do it more than once a month. Some people might also want to buy shares daily. Set up a time frame that works best for you. In addition to determining how often you are going to buy shares of stock, you also have to decide how much you can invest. Of course, generally speaking, people should invest as much money as they can. But you also have to balance that against the reality of your day-to-day expenses and other needs that will come up. At this point, we need to say a word about savings, emergency expenses, and debts. If you are carrying a large amount of debt, aside from a home mortgage, it's essential to get yourself out of debt. Any liability that you are taking in the form of personal loans, credit cards, car loans, student loans, and so forth is terrible for your financial health. Many loans may carry interest rates that will outweigh any gains you are making in the stock market. So while you are holding these debts, even if you are investing in stocks, your net worth could be decreasing. If you need to get a second job or create a small business to generate more income to take care of it, then you should seriously look into doing so. Second, everyone should have some emergency cash on hand. The amount you need varies, but you should add a minimum of $1,000 on the side to handle emergencies like car repairs, tire blowouts, roof leaks, broken water heaters, pet emergencies, and so on. Make sure you have some emergency fund on hand before you start putting all of your available cash into the stock market. Many financial advisors say you should have 3 to 6 months of expense covered, but of course that is a lot of money, and so if you don't have any money saved up, you are going to have to work on this over some time. For now, focus on getting a cash fund of $1,000 you only touch when you need the money. You should also avoid using credit cards to pay for emergency circumstances once you've built up a reserve. Get a clear picture of your financial health. Before you dive into investing, make sure that you have a clear picture of your financial health. Start by listing all of the assets that you own, everything from cars, cash, retirement accounts, to computers and other items. When doing this, only include equity in these items. So if you owe $4,000 on a car worth $17,000, then you have $13,000 in equity. List your liabilities. You should list the total amount owed, the amount needed to pay off each item, and the monthly bill. When listing your debts, also include the interest rates. Also include any other debts like back taxes. When you make a debt repayment plan, you should try to pay off debts that have the highest interest rates first. Payment on interest is the money going out the window. It enriches the creditor while keeping you from devoting cash toward paying off the debt. Investment strategy. We need to have a clear understanding of why we would use investment strategies in the first place. The reasons include spreading risk. Remember that you should never bet your life savings on one investment. Some investments are bound to fail, so one goal of an investment strategy is to spread the risk so that the inevitable failures don't destroy your entire investment portfolio. Buying at the wrong time. The last thing you want to do is be the person that is always buying at market peaks. That means you'd be buying high and then hoping the market will be rising even higher. Also, you'd be paying more for your shares than you need to pay. Staying focused on your goal. You want to ensure that at all times your investment portfolio is helping you maintain and reach your long-term goals. Invest long-term. Long-term investing is considered the best way to be involved in the stock market according to most financial advisors. There are many reasons for this. For one, long-term investing is far more likely to provide gains in wealth over time. It is the only way that you can ensure that you have wealth to draw on for living expenses during retirement. Historical data indicates that over the long term, stocks from most established companies are going to appreciate. And over the long run, you will have many opportunities to adjust and move your money out of losing stocks and into winning stocks. If you also invest in dividend stocks, long-term investing with dividend reinvestment will also lead to the benefits you get from compound interest, which means that you will have your money working for you to grow even more money. Short-term traders don't benefit from compound interest in any way. Another advantage of long-term investing is that it's a low-key and low-stress, not to mention something that isn't complicated. With long-term investing, you pick out a set of dependable companies and possibly some index funds and buy shares at regular intervals. A long-term investor should not be concerned with the short-term fluctuations of the stock market, even recessions. The long-term change volatility average and downturns overtaken by future economic growth. While traders are sweating bullets over short-term fluctuations in the stock market, long-term investing doesn't require you to get stressed out over daily or weekly ups and downs, the kind that always occurs. While commissions can cut into the profits of traders who are buying and selling frequently, often making small per-share profits, commissions are not that important to long-term investors. You aren't going to be making multiple trades in a day, and most long-term traders won't be making various trades over a week, so that commissions will far less impact it on your bottom line. Also, over the long term, if you pay a $5 to $10 fee for a trade now, that small amount isn't going to matter compared to the appreciation the stock is likely to see over 5, 10, or more years. A long-term investment strategy also removes the trader's way of trying to get in and out of the market at the exact right moment to profit. It reduces stress, and it also significantly lowers risk. When you are trying to exactly time buying and selling of stocks, chances are you are going to have a lot of errors, and so you're going to lose money, or put another way, it's a much higher risk. Everyone has their preferences and level of risk they are willing to accept, and some people even find the pressure cooker of day trading, swing trading, and options trading exciting. Others prefer the comfort, stability, and likelihood for success that long-term investing provides. So, this is something you will need to evaluate for yourself, and you will need to be sure to go into your investing or trading with open eyes so that you know what you are getting in. Trade. With this in mind, you might ask why people bother trading. They do so because they enjoy speculating, diving deeply into the financial markets, and they have a goal of earning profits in the present day, rather than investing for the sake of building wealth over time. Trading is high risk, but it can work for some people who have the skill and dedication to make it work.